Hello, my name is Eric Emmons. This is my financial analysis presentation. What I want to do first before I actually get into my first industry is to explain a little bit how I actually analyze the companies against each other. So what I did is I have this chart, put the 5 companies at the top, and I put the 5 areas that we looked at for each company on the side. So what we actually do is, as we go through each section, I'm going to check mark off where each company does really well, and also put a big red X in those categories where that company maybe did not do so well in. So at the very end, once you go through all 5 of these categories, you're going to be able to visually see which companies did well, which didn't, and then we can also pick our best company. So the first industry I did was the beverage industry, non-alcoholic beverage industry. Dr. Pepper, Pepsi, Coca-Cola, Monster, and Jones Soda. So starting right off, we wanted to look at the short term, which is the liquidity. A few ratios that I went through and compared them to. Current ratio, Monster actually led here with a 3.5. What we actually liked here also is that they were very consistent. It wasn't a very big change over from one year to the next. Jones Soda came in close second with a 2.8, also very consistent as well. The other 3, Dr. Pepper, Pepsi, and Coca-Cola, all sitting around a 1.0. So between all 5, the current assets are being able to cover the current liabilities. But Monster is able to do this by 3.5 times. Taking the inventory out of the equation, at the quick ratio, Monster still has a 2.8, so it didn't drop as much, which is great. Jones, on the other hand, dropped to about a 1.5, so what they're saying is roughly about half of their current assets does lie in inventory, which could be a little concerning. But they do have a low asset turnover, which I'm going to mention a little bit later, which is not in a good position for them to be in. The other companies drop a little bit below 1.0 here. And then breaking it down even further, just looking at the cash for the cash ratio, almost all the companies dropped a little bit lower with the exception of Jones, which was interesting. So even though Jones' quick ratio was still okay, just dropping down to straight cash was not an issue for them, which just means they have a decent amount of cash on hand, which is good. The downside here, though, is Dr. Pepper. Their quick ratio dropped very, very low, down to a 0.1, very low cash on hand. Which, when we move to the leverage, the last part that we're looking at with liquidity, Dr. Pepper, Pepsi, and Coca-Cola, I'm starting to see a little bit of similarities between the numbers with them. Their leverages were about a 2 to 3, not too much difference between them. The last 2, Monster and Jones, even though some numbers came up in Bloomberg, they actually have 0 debt. Both companies have no debt, no liabilities to cover over there. So their leverage is absolutely 0, which, as we know in class, we want some debt, but not too much debt. In their case, they have none. So what I do want to note here is Dr. Pepper does have a very, very low cash ratio, but they have the highest leverage out of all of them. So this is not going to be good. So in the short term, Monster obviously looks like they're going to be the best, followed closely by Jones Soda. But because of what Dr. Pepper's standing in the short run, they're going to be getting the X. So we go down to the next one, the cash coverage. This is going to be pretty much if they can afford the debt. Dr. Pepper and Pepsi both at a 12, not too bad, but Coca-Cola comes in at 22, twice as likely to be able to cover their debt, which is great. So they're going to be getting the check on this. Monster and Jones Soda, even though they don't have any debt, they are able to pay back even if they did. So what they're going to get, I'll put 2 little check marks up there. Asset turnover, we want this to be very high. I expected these first 3, Dr. Pepper, Pepsi, and Coca-Cola, to have the highest. But surprisingly, they averaged around a 0.5 to a 0.7. Jones Soda actually leads with a 2.1, with Monster at a 1.6. So again, very, very similar numbers. We're seeing Monster and Jones come out ahead on this one again. But when we start looking at profitability, this is where some of the other differences start to come out. First, looking at the profit margin, again, Monster leading 17% profit margin. but it's also being consistent. Dr. Pepper, Pepsi, and Coca-Cola, they're consistently around 10 to 15%. Again, very similar in numbers. But the thing about Jones Soda is they've had negative profit margins since 2006. So from 2006, every single year to present time right now, they've been losing a lot of money, which is definitely not how you want to run your business, especially in the long term. They're at a negative 47% return on equity, but this is being run by these negative profit margins. Their total asset turnover, it's great. That's fine to have a great asset turnover, but without a positive profit margin, really means nothing. So we're obviously going to give Monster the check here. Negative profit margins are especially a bad thing. They're going to get 2 X's for that. So going down to the last one, market value. We had determined that we were going to be looking at PE ratios. So we want the high price that determines the future cash flows over the earnings. So none for Jones right off the bat. They haven't had any earnings. They're not going to be getting the PE ratio there. Once again, we're seeing a pattern relatively the same for the first 3, Dr. Pepper, Pepsi, and Coca-Cola. Hovering around 20. Monster leads again at a 31 PE ratio because the high future cash flows that are expected. So again, because of the earnings, Jones gets that, Monster gets the last check. So if we stand back and we take a look, the obvious winner here that I'm going to choose in my book is going to be Monster. Okay, so as we take a look at the second industry that I did, which was the renewable resource companies, and I actually picked 5 companies that are involved in the solar power industry. So we got Solar City, SunPower, Canadian Solar, First Solar, and Trina Solar, and took a look at them against the 5 areas that we did with our first industry. So in the short term, liquidity started off with the current ratio just like before. First Solar leads with a 3.04, and it actually had been steadily increasing over the years. They've been getting better. Solar City also steadily increasing over the years, currently at a 221. The other 3, SunPower, Canadian Power, Trina Power, are hovering around a 1, which still is not considered bad. So far, Solar Power and Solar City are both leading here. Check out the inventory. First Solar and Solar City are also still leading around a 1.6. The other 3 below a 1. So without their inventory, they're not able to cover their current liabilities with their other current assets. Being in this industry, new and upcoming, I really don't think it's a good thing to have a lot of that inventory counted as your current assets, just in case something would happen. As far as the cash ratio goes, SunPower, Canadian Power, and Trina Solar, which were lower before, dropped very, very low. They're well below a 0.5 here. The other 2, First Solar is still at a 1.3 and Solar City is still at a 1.5. So even when you break it down all the way down to cash, still able to cover your current liability. So those 2, at least in the short term, are ahead here. Then taking a quick look at the leverage, First Solar is at a 1.4. Solar City is almost to a 5, but they are actually very, very high, well into the double digits just a couple years back. Others, they're hovering around a 3 or a 4. Again, nothing good, nothing bad here. So with that said, just in the short term for the liquidity, Solar City and First Solar are going to take those first 2 check marks. Going down to the next one for the cash coverage, whether or not they're going to be able to afford the debt. First Solar started off with a 75, so the debt that they got out of all 5 companies, they're easily going to be able to handle paying that back. Solar City, though, is actually in the negative. Solar City had the highest leverage at all 5 companies, and they also have a negative cash coverage. So not being able to afford the debt by having the most debt is not good at all for a company, especially long term. So First Solar is obviously going to take this one again, but Solar City is going to get the big X on this one just because of this mixing in with the leverage, the high leverage that they have. Asset efficiency turnover, really between all 5 companies, was almost even. They range from about a 0.5 to a 0.9 across the 5 of them. So in order to pick a winner here, I had to just take the highest one, which was Solar City. But since they were relatively close, they get a small check for that one. Moving down to the profitability, though, this is where I started to see a little bit of differences between them. First Solar came in first, 11.8% profit margin, which is great. Solar City was actually in the negatives, though. They've been very inconsistent. Some years, some quarters going up, down, and this just happened to be a negative profit margin for this previous year that we did this report on. Had to look for a second place. SunPower, they're actually at a 9% profit margin, which was great. So during this profitability, First Solar and Solar Power, I'm gonna give Solar Power a check as well because of their 9% profit margin. But Solar City gets the double X's. Again, profit margin is huge. That's the reason why businesses are in business, is to make profit. So they get two X's here. Last but not least, looking at the market value, Solar City is not going to have one without a positive profit margin. You're not making any of the earnings. So First Solar comes in around 15. They've actually been consistent over the years too. So positive market value and consistency. SunPower is high, but that's also because of low earnings. They didn't have any earnings in 2011 or 2012, so even though they had a pretty good market value just recently, they have not been consistent. So they're not going to get that check. First Solar is actually going to get one, and Solar City gets an X because they don't have a market value right now. So looking at this industry, I think anybody can clearly see First Solar is the leader here. All right, so my third industry was one of the same industries everybody else did, the gaming industry, which included Boyd Gaming, Isle Capri, MGM, Penn National, and Pinnacle. And what I did was the same thing I did for the other two industries, was rank them up against each other through each of the 5 categories as before. So starting with liquidity in the short term, some of the numbers that Bloomberg gave were a little off, didn't really match up, didn't really make much sense. But looking at all the ratios together from the current quick to cash, Pinnacle was the only one that had a 1.5, a company above a 1 once you broke it down all the way to the cash ratio. The rest seemed to fall relatively the same amount at the same level as you work your way down to the cash ratio, with the exception of Penn for the short term. But they also did have the highest leverage, which as of right now does not mean much to me being the short term. The companies are relatively the same. But looking on a specific ratio basis, Pinnacle is actually going to take this category just for the short term. But when it comes down to who can afford the debt, Penn was actually the highest at a 6.8. Which is very good because they have a debt to equity ratio at a 1.08, really, which means they have more debt than equity. So having that high debt right there, they need to have this highest cash coverage to make sure that they are able to take care of their debt. Here we're only really worried about whether they can afford it or not how much debt they have. So taking a look at this, they definitely have what they need. The other 4, they're all between a 1.8 to a 2.8. This really is not a big deal right now relative to what Penn has, which is the highest. They are going to take this category. So looking over to asset efficiency, within all 5 companies, the asset efficiency ranged from a 0.4 to a 0.4 with MGM and a 0.74 with Penn. So all 5 companies are right there in the same exact range. If you think about the industry altogether, the gaming industry, asset turnover, I'm not really sure what assets they're going to be turning over and making that number larger. So those smaller numbers across the board does really make sense. In order to kind of rank them here, I do have to pick the highest one, which again is not going to be by much, but ends up being Penn National. Because they are also close, they get one of the small checks as well. Profitability. Again, this category is usually where we see the separation between the companies that are doing what they're supposed to be doing and the companies that aren't. Penn leads here in the profit margin category due to a couple things. Their ROE, it was recently down, but in the past they had been consistently making higher margins. Boyd and Isle Capri both had negative profit margins and really had not been consistent on their returns. They've had returns in the past, but from one year to the next, it's definitely not been consistent. But MGM also had a 4% profit margin, but their own returns were minimal. Pinnacle had some margins, but historically they have been running into the negative numbers. So when you look at everything here, Penn is going to get the check, but just because of the negative profit margins, I'm going to split those two red X's between Boyd Gaming and Isle of Capri. Lastly, we're going to look at the market value. The market value here was no PE for Boyd. We need some earnings here. MGM, they posted low earnings, which shot up their PE ratio. Their PE ratio was the highest, but in terms of what we're looking for, that wasn't a good thing for them. This category actually goes to Pinnacle. It was very small, but they had the most consistent PE ratio out of all five of them. Historically, they did not have the earnings for this, but they are heading in the right direction. The way they're heading right now is where they need to be. So. Pinnacle gets the small check. Boyd Gaming gets the negative for the negative earnings. So Penn National Gaming for this industry is the clear winner for me. They have very high debt, but they're able to easily pay it off. So like we said before, we like debt, not too much debt. They have a lot, but if they have enough to be able to cover it, then it's not going to be too much. They are using their leverage very well, which is showing up in the profits, so that's why I'm going to be picking them. So the last part of this project was, out of the three industries, we wanted to take the three companies that we thought were the best and compare them against each other between the different industries to see how they had matched up. So with the beverage industry, the non-alcoholic beverage industry, we had Monster. We also have First Solar from the renewable resources industry, which was focused mainly on solar panel power, and Penn National, which is what I chose for the gaming industry. Just some of the things that I wanted to put up here about each. With Monster, they are very liquid, absolutely no debt, which can be considered a good thing, but as we all know, some debt, there is a positive effect to have some kind of debt, and great asset turnover. Moving over to First Solar, they are also very liquid, some debt, but they're also very easily able to afford it. As well as Penn National. They are not as liquid per se, have very, very high debt, but they're easily able to pay that off. So a little bit of difference between the three right there. Margin-wise, 17% margins for profit margins for Monster. First Solar's a little bit under that at 12. Both projected to have great future cash flows, which is something you obviously want in a company. The thing with Penn National Gaming, though, they are bringing in some returns, which is why I had chosen them. But they have huge negative economic value added when I went to look them up. As an example that we used in class, gaming is really doing nothing, essentially just trading money between one area to another. It's not actually building up an economy like building a house would. So just with that, that's taking Penn National out of the running for me. So really between Monster and First Solar, I could take a look at their profits, the 12 to 17%, and possibly go with Monster on this one. But in fact, my top company that I'm going to be choosing is First Solar. for a couple of different reasons. Um, the industry itself is the main reason. If you look at the non-alcoholic beverage industry, I see better growth over here. You look at the big players, the Coke, the Pepsi, the Dr. Pepper, we had just talked about those. Huge brand loyalty. I think if you're not one yourself, you probably know somebody who is going to drink nothing but Coke, nothing but Pepsi. They always got to have one every day. I mean, they have that loyalty where you're not going to be able to pull customers from that. It's a very saturated market. With First Solar, this industry is up and coming. This may be the next best, greatest thing to hit the energy sector, and that might be something that I would want to get into. I think it's worth going into with the growth opportunity, and like I said, I think there's less barriers here if indeed that sector takes off. So out of those three, First Solar, they got the right company structure. They're making money, still relatively new, but the potential for their future is huge. So that's why I'm choosing First Solar, and thank you.